Imagine you're vacationing in a foreign country where everything, including the language, culture, climate, and food, is new to you. On day one, you do the regular touristy activities, and by evening, you're starving. You want to end your day by having a great dinner. You ask around for a good restaurant, and you're told about a nice food street close by. You decide to give it a try. To your surprise, many vendors are selling different varieties of food. Everything looks different and interesting. You are absolutely clueless as to what you want to eat for dinner. To add to your dilemma, you cannot ask around as you do not know the language. Given all this, how will you decide on what to eat? Well, you have two options to figure out what to eat. Option 1. You visit a vendor, figure out what they are cooking or selling, check on the ingredients used, cooking style, probably taste a little bit, figure out if it's actually the food that you like. You repeat this exercise across a few vendors, after which you end up choosing and buying what you like the most. The advantage of this technique is that you know exactly what you are eating since you've researched independently. However, on the flip side, the method you have adopted is not really scalable. There could be about 100 odd vendors, and with limited time you can probably cover about 4 or maybe 5 vendors. Hence, there's a high probability that you could have missed the best tasting food on the street. Option 2. You stand in a corner and observe all the vendors. You try and find a vendor who's attracting the maximum crowd. Once you find such vendor, you make a simple assumption. The vendor is attracting so many customers, which means he must be making the best food. Based on your assumption and the crowd's preference, you decide to go with that particular vendor. The chances are that you could be eating the best tasting food available on the street. Now, you would ask, why am I telling you food stories and what does it have to do with the stocks? Well, what if I told you option 1 is fundamental analysis, where you research a few companies thoroughly, whereas option 2 is very similar to technical analysis, where one scans all the opportunities based on the current trend, aka the market's preference. Hello everyone, I am Shakshi Sodhani, a second year PGDM student from SPJIMR Mumbai and a qualified chartered accountant and company secretary. And in this video, we will be exploring both of these in detail and understand how they differ from each other, which one you should follow and what yields the best result when it comes to making financial choices. Before we move ahead with the video, a quick announcement about a program that can help you learn about the world of finance and investing better. Inside IIM and AltUni has come up with a dedicated program named Finance CareerPro, where you can learn from the best in the industry. More about the program would be discussed later on in this video. Often, people get into an argument contending a particular research technique is a better approach to the market. However, in reality, there is no such thing as the best research approach. Let's explore the two approaches we talked about earlier in detail. Firstly, let's talk about technical analysis. We know that developing a well-researched perspective is critical for stock success. A good point of view should have a directional view and should also include information such as price at which one should buy and sell stocks, risk involved, expected reward, and expected holding period. Technical analysis, also abbreviated as TA, is a popular technique that allows you to do just that. It helps you develop a point of view on a particular stock or index and helps you define the trade, keeping in mind the entry, exit, risk, and perspective. TA helps you identify trading opportunities in the market based on market participants' action. The action of market participants can be visualized utilizing a stock chart. Over time, patterns are formed within these charts and each pattern conveys a certain message. The job of a technical analyst here is to identify these patterns and develop a point of view. One of the greatest versatile features of technical analysis is the fact that you can apply technical analysis on any asset class as long as the asset type has a historical time series data. Time series data in technical analysis context is the price variables information such as open, high, low, close, volume, etc. Here is an analogy that may help. Think about learning how to drive a car. Once you learn how to drive a car, you can literally drive any car. Likewise, you only need to learn technical analysis once. Once you do so, you can apply technical analysis concepts on various asset classes, equities, commodities, foreign exchange, fixed income, etc. This is probably one of the biggest advantages of technical analysis compared to any other field of study in this area. For example, one has to study the profit and loss, balance sheet and cash flow statement when it comes to fundamental analysis of equity. You can access free courses by Udemy, Nifty Trading Academy, etc. and many more such courses to get some experience in technical analysis. These are a few parameters that indicate trends in stocks. Here the study of charts and lines indicate the movement of price for a particular period, basis which the buy-sell decisions are taken. Now let us come to fundamental analysis. Fundamental analysis or FA is a more holistic approach to studying a business. When an investor wishes to invest in a business for the long term, say 3 to 5 years, it becomes essential to understand the business from various perspectives. Over the long term, a fundamentally strong company's stock prices tend to appreciate, thereby creating wealth for its investors. We have many such examples in the Indian market. To name a few, one can think of companies such as Infosys Limited, TCS, Bosch India, Nestle India, etc. Each of these companies has delivered an average of over 20% CAGR or compounded annual growth return year on year for over 10 years. At a 20% CAGR, the investor would double his money in roughly 3.5 years. All investment grade companies have a few common attributes that set them apart. Fundamental analysis is the technique that gives you the conviction to invest for the long term. It helps you in identifying these attributes and also decide which companies are actually wealth creating companies. To sum up, fundamental analysis enables you to read the pulse of the company. You understand the financial dynamics within the company and determine whether that is in good state or there are some problems happening internally. Fundamental analysis has a number of disadvantages as well. Like, it is very tedious and time consuming. You may need to hold it for a long term. Since you are looking at the longer perspective, you might not look at the trade signals and may exit too early or get manipulated numbers. Technical analysis is used to forecast a stock. All of the technical indicators give possible entry and exit points. The forecasting accuracy, however, is not 100%. For example, when a possible entry or exit point of a stock is suggested, it does not guarantee a successful trade. Stock may decrease after the entry. Stock can also rise after the exit. Also, one technical analyst's opinion may contradict another analyst's opinion for the same stock. The technical methods that are used to analyze stocks can vary from one analyst to another. However, one must realize that both technical analysis and fundamental analysis can coexist in the market strategy. Let us say a market participant has a corpus of around 10 lakh. He can split this corpus into two unequal portions. For example, the split can be 60-40. 60% of that capital, 6 lakhs, can be invested for the long term in fundamentally strong companies. This 60% of the investment makes up for the core of the portfolio. One can expect the core portfolio to grow at least 12 to 15% CAGR on year-on-year basis. The balance 40% of the amount, which is 4 lakhs, can be utilized for active short-term trading using technical analysis techniques on equity, futures, options. To try this out, enroll yourself in any of the mock trading platforms and use token money to apply your analysis on a stock of your choice and evaluate your returns. To learn more about such concepts in detail and get a better idea about the world of finance and investment banking, register yourself for the Finance CareerPro program brought to you by Inside IIM and AltUni. It will help you learn about the mechanics of finance, investment banking, along with some very important concepts and domains taught by IIM-A, B, I, and XLRI alumni who worked with marquee companies in the past. Understand investment banking, learn about different stocks and the future of finance. Also learn how to apply the financial management concepts through this program. If you're interested in the Finance Career Pro, enroll yourself today. The link is in the description below. Don't forget to like, share and subscribe, and Inside IIM will keep coming with new such topics and episodes. Thank you.